Today we're talking about metrics every investor needs to know. Investing requires thoughtful evaluation to determine if the deal is right for you. There are specific metrics though to make sure that your team and business is profitable. Here are the 8 metrics you and your team need to know. Number 1 is net operating income, or NOI. The net operating income, or NOI, is a real estate metric that tells you how much money an investment property makes you. To calculate your net operating income, start with your total income and subtract your operating expenses. Number 2 is capitalization rate, or you may have heard this called a cap rate. Capitalization rates are used to estimate the potential returns a real estate investor stands to gain on a property. To calculate the cap rate, simply divide the annual net operating income by the cost of the asset or its current value. Number 3 is internal rate of return, or IRR. When you calculate your internal rate of return, you are estimating the earned interest in each dollar you invest in the property over the holding period. This rate of growth shows the potential return a property can generate over the long term. According to DealCheck, IRR is calculated using trial and error versus its own algebraic equation. You can do this using the equation here and having the net present value equal 0. Number 4 is cash on cash return. The cash on cash return takes the total amount of money you have invested in your property and calculates the total return rate you are earning from this investment. The real estate investment formula includes costs such as debt service and your mortgage to accurately calculate your total return. To calculate the rate of cash return on a property or your entire portfolio, you divide your net cash flow after debt service by the total amount of cash you put in the deal. Number 5 is operating expense ratio. The operating expense ratio provides a measure of profitability and shows whether you are controlling expenses adequately for the income produced. To calculate this, subtract depreciation from your total operating expenses and divide that total by your operating income. Number 6 is loan to value ratio. The loan to value ratio measures the equity you hold in a property and allows you to assess the value of your portfolio while accounting for your debt. It would be unusual for a lender to finance a full 100% of a property's value because there would be no protection for the investment. Instead, lenders offer a percentage of the total price and expect the remaining amount to be covered by your cash down payment. Debt service coverage ratio. The debt service coverage ratio measures your company's ability to pay back all its debt obligations with its operating income. To determine your DSCR, divide your net operating income by debt payments. You can calculate this ratio on a monthly, quarterly, or annual basis. And number 8 is cash flow. Cash flow is one of the most important real estate investor metrics because it measures how well your business is doing. Your cash flow is the net cash you have left at the end of the month after all your expenses have been paid, including debt services. If you weren't able to write these down and have more information about the importance of these metrics, go ahead and check out our free ebook below in the description just for you. Highly recommend checking out this video next if you are starting out in your REI journey. And as always, happy deal finding.